Alright, welcome back to another video on the After Hours channel. In this video, we're going to be discussing the age-old question that most investors face. And that question is, if you can't beat the market, why invest in individual stocks? It has historically been proven that most investors cannot beat the market. But don't take my word for it. We can see plenty of articles out there. This one from Business Insider illustrating just that. Most investment pros can't beat the stock market, so why do everyday investors think they can win? And it not only deters investors from trying to beat the market, which is absolutely possible, but it creates a stigma within the market that scares investors out of individual holdings. 2 weeks ago, I published a video and I titled it How I Crushed the S&P 500's Returns. And in this video, I illustrate that in 2023, I actually outperformed the market by nearly double. My portfolio at the end of the year was up nearly 50%. How did I do this, you may be wondering? Well, I invested in great companies, and not only great companies, but compounders. Companies that are industry leading, have incredible balance sheets, have very large moats, and are extremely hard to disrupt in their individual fields. So for anybody out there that's unfamiliar, when we're talking about beating the market, we're talking about beating this ETF right here, SPY. This historically has been the comparison to most investors' portfolios out there to see if they did better than the overall stock market. And as we can see, if we look at the max timeline for this holding, it is up 250%. And this goes back to 2000. But for this video, I wanted to highlight a company I came across that has not only beat the S&P 500 over an extended period of time, but absolutely crushed it. That company I'm referring to is none other than Pool Corp. When we compare this company to the S&P 500, you can see that it has returned since 2000 over 7,200%. So crushing the S&P 500 would be an understatement. And not only has it crushed the S&P 500 over time, but if we look at the max timeline of this company, you can see that it has done much better than just 7,200%. This company has had returns over 40,000%. When we compare this to the all-time returns of SPY, you can see it's only up 904%, which is good. I'm not saying that's a bad return, but when you're putting these two together and comparing them, 41,000% is insane. It's hard to even grasp. So how did a company like Pool Corp manage to have outsized returns that have historically beaten the market over and over again? This company is the world's leading distributor of swimming pool supplies, equipment, and related outdoor products. Definitely not a company you would think would have outsized returns, especially exceeding 40,000%. Like many other holdings in my portfolio, Pool Corp has an incredible balance sheet. If we look at the financials of this company, they are insane. Revenue going up year after year, EBITDA going up year after year, and their free cash flows going up year after year without issuing a ton of stock to their employees and diluting their shareholders. Not only that, but they have minimal debt that they could easily pay off whenever they wanted to. They pay an increasing dividend, which is increased multiple times a year. And not only that, but they have a really low payout ratio, which signifies good financial health and the ability to increase their dividends over time. So before we get into the financials of this amazing company, I want to first take a look at some of these articles and point out some of the statistics that they highlight in it, because it really is very eye-opening and something I think you guys should know as investors. Hitting the key bullet points for this article, we can see that according to a 2020 report over 15-year period, nearly 90% of actively managed investment funds failed to beat the market. Now that's pretty surprising. Over a 15-year period, 90% failed to beat the market or SPY. So again, it leads investors to think, why would we even try? Now the thing that they fail to mention in here is actively managed funds, especially hedge funds, have a whole different set of rules that they have to play by, whereas investors like us do not have those same restrictions. If I take a look at my portfolio right here, you can see that I have very minimal holdings. For most actively managed funds, this would never fly. This type of portfolio would be considered too risky, and they would not want to hedge billions of dollars on just a few companies. Even though if you take a look at the financials of all of these companies, it is incredible. Extremely well-run companies that have balance sheets you can only dream of. So when you're diving into these articles and you see that 90% of actively managed funds and the investment pros, quote unquote, can't beat the market, so why should you try? Just understand that there is another set of rules that you do not understand and we do not know of that they have to abide by. If they only invested their funds into the largest companies like Apple and Microsoft, which historically have been performing very well, then why couldn't the people investing in those funds just pull their money out and do the exact same thing? These funds want to be different and they have to be different to attract new investors. Otherwise, why would people use them? Second bullet point we're going to take a look at, it says portfolio managers are often Ivy League educated investors who spend their entire workday attempting to outperform the stock market. Wow, makes you feel even worse not being an Ivy League educated investor, but yet they still cannot outperform the stock market. Now, I have went through nearly all of the portfolios on this super investor list, and let me just tell you, there are a ton of companies in these portfolios I would never buy. You look at the financials and they are in the negative year after year, losing money. Now, don't get me wrong, there's a few portfolios in here that I emulate, and there's a few holding ideas that I've gotten from some of these portfolios, but when we're looking at a list this large of quote unquote super investors who manage a portfolio with over $100 million, there are easily hundreds of companies I would never put a single dollar into. So when you see those types of headlines and articles like this, just remember the investment thesis and strategy for these investors are mostly unknown. And the reason they bought some of these companies we'll never know, because if we look at the financials, they do not look good. But lastly, let's take a look at this bullet point. If investment professionals can't consistently beat the market, it's unlikely that the typical at-home investor would achieve better results. Well, it's funny you mention that, because I proved in 2023 I could do just that with nearly 50% returns for the year. And now I understand I'm just an at-home investor, so I don't understand what's going on, and believe me, I get it. There is probably a ton of information out there that I don't fully grasp in comparison to some of these professional investors. But the stigma associated with not beating the market, especially for at-home investors and your everyday investors, is just a fallacy. It's not real. And there are a ton of examples out there where people just like me have outperformed the market over a longer period than just a year. So when we're talking about a pool supply company that has seemingly destroyed the market over an extended period of time, it's worth looking into. Currently, this company is trading at $376 per share. If we take a look at the valuation, we can see that it has a market cap of $14 billion. So this is not a small company. Current PE is 27 with a forward PE of 25, so it looks like it's trading on the higher side. If we take a look at the balance section, we can see that they have on hand $85 million of cash. They are currently in debt $911 million, which nets out to $826 million in debt. As for the dividend, we can see it's currently 1.15, so a bit on the lower side, and the payout ratio, as I mentioned earlier, is only 30%. So 30% of their net income is paid out in dividends. When we take a look at the revenue for this company, we can see that it has been shooting up since around 2009, going up over 11% for the 10-year average. When we look at the EBITDA, we can see that it resembles the revenue pretty closely, going up nearly 20% for the 10-year average. As for the free cash flow, it looks like it kind of had a stagnant plateau for a little bit, and then they consistently were able to raise those free cash flows. In the last 2 years, going up over 26%, and in the last 10 years, over 17%. So that is huge growth. Of course, we want to see if they're diluting shareholders by issuing new shares, and it looks like for their free cash flow, they made $441 million, and they paid out $14 million in stock-based compensation. I always mention I love to see when their stock-based compensation is not growing a lot over time, they keep it under control. And it looks like this company is doing just that. We take a look at their net income and we see the same exact thing over and over again. We're seeing a ton of growth, going up over 22% in the last 10 years. And when we're talking about dividend paying companies, this is one to keep an eye out for. Increasing their dividend 10% in the last year alone, and in the last 10 years increasing it by over 19%. That is crazy growth and a crazy increase for their dividend. Even though it's only at that 1%, this is a company you want in your portfolio, someone that can increase those dividends multiple times a year, and not only that, but keep their payout ratio low while they do it. This company is clearly prioritizing returning money to their shareholders and saying thank you. And when we take a look at the shares outstanding for this company, we can see that they are going down year after year, which means this company is doing share buybacks. So not only are they paying out an increased dividend, but they're buying back their own stock, which increases your value as a shareholder. You may be thinking to yourself, all of these financials cannot look good for this company. Something has to be off. So we'll take a look at the returns on capital employed. In 2022, being up over 35%. So that is extremely high for most companies. And not only is it above average for 2022, but every year consistently is above average, even in their lowest year in 2009 being over 18%. So this company clearly knows how to invest their money and get a return on that cash. So why did I bring this up and decide to make a video about Pool Corp? Well, the answer is simple. There is a similarity between all of the companies that outperform the market and the companies that do not. That similarity that you've probably already caught on to is great financials. When you focus your attention on high grading your portfolio and buying industry-leading companies that have compounded over time, you will see that it is much easier to outperform the market. You do not have to go to an Ivy League school or be a professional investor to identify a great company. Now, there's a little back-end work that you definitely have to do, and you always have to take a look at their balance sheet, but in my experience of investing, the financials typically speak for themselves. And as long as you're identifying well-run compounding businesses that have the financial sheets to back up their price point, you will typically do just fine in the market. And that is exactly why I hold companies like Microsoft, Apple, United Health Group, Vici, and Visa. I not only believe these companies will provide outsized returns over time, but I think they'll easily outperform the market over the next few years. And that is exactly why I'm making these videos, to take you guys on the journey with me. A full transparent view into my portfolio to show you what it's like to be an average at-home investor. So if you got anything out of this video, please don't forget to like and subscribe. And of course, if you have any questions, feel free to leave them down in the comments below. I'll be sure to get to them. But going forward, remember, don't believe everything you hear, and I wish you the best of luck for 2024. I will see you in the next video. Take care.